So, as was the case in chapters 4 and 5, where we were just expanding on the knowledge that we had already gained from chapters 1 through 3. Chapter 6 is just expanding on what we have already been learning about, okay? More specifically, chapter 6 is expanding on our understanding of cash, right? So chapters 4 and 5, we were really had tunnel vision on inventory. We were doing journal entries for how, when we buy inventory, when we sell inventory, we were learning those different costing methods in chapter 5, FIFO, LIFO, weighted average, specific identification. And so we sort of had tunnel vision on inventory. In chapter 6, we have tunnel vision on cash, okay? And so we still have to recall the things that we learned about in chapters 1 through 3, those foundational principles that we sort of go back to as we learn more about these different accounts. And so the first thing that we want to put up here is the accounting equation, which is what? Assets equals liabilities plus equity. And there are 4 components of equity that we've been discussing, right? What are they? Right? And in chapter 6, even though we're going to be sort of hyper-focused on cash, which is an asset, we still are going to make a few journal entries as it relates to cash, right? So we still need to know how to increase and decrease each one of the elements of our accounting equation, right? So we've been putting that up on a whiteboard for a really long time now. And that's because we still have to use it almost every class period. We still have to sort of recall, right? This is that foundational knowledge that we have to go into the back of our brain and say, okay, let me bring this back out because I need to remember, how do I account for cash? What are the debits and credits that I have to make if I need to make an entry in cash and those kinds of things, okay? But the resources that I'm going to use are already available to you in Moodle. So there's a PowerPoint presentation, there's an Excel spreadsheet, and then you can see that there is a reminder, right? You don't have to submit anything in Moodle, but there's a reminder about the chapter 6 smart book review and the chapter 6 homework assignment. I understand that after the midterm, you may have needed to decompress for a hot minute. And if you didn't get the smart book review done by class time today, I will still accept it for full credit by the end of the day today. If you don't get it done by the end of the day today, try to get it done tomorrow. I'll only take off a point, right? I'm not stingy with points. I'm very generous with points when it comes to homework. If it's a couple days late, I only take off a point, okay? But keep in mind that in addition to that smart book review, that there is a homework assignment for chapter 6. It is a short homework assignment in Connect, but a homework assignment in chapter 6 in Connect that will be due on Wednesday. Okay, so again, just an update on what we have coming up. I'm sorry, today's Wednesday, Friday. Fall break wasn't long enough. Fall break needed to be like 2 weeks. And then we come back all refreshed and none of you would have remembered anything that we talked about before. Thanksgiving is next, right? But at least Thanksgiving is sort of like a cutoff, right? You take your final exams for the 12-week. You get a nice long break for Thanksgiving. You come back refreshed and ready to tackle your 3-week class. Okay. Anyway, that's my pep talk for today. Cash. So not only in this chapter are we going to discuss cash, but we're actually first going to discuss a concept called internal control. And I may have talked about it briefly in previous chapters, but in this chapter, we're going to dive deep into it. And the reason why we dive deep into it in this particular chapter is because internal controls are super important when it comes to cash, right? Cash is a number one asset that we list on our balance sheet, right? The company cannot function unless cash is flowing. So we have to make sure that there are safeguards around our cash. That's what internal controls are. Internal controls are the accounting jargon for safeguards. We want guardrails around our cash to make sure that nothing happens to it, to make sure that it's being managed properly. And the way that we do that is by implementing, again, what we call internal controls. We'll jump to the objectives. Once we have a discussion of internal controls, you will see in your next quiz a couple of short answer questions, and we'll talk about that when the quiz comes up. A couple of short answer questions in the quiz related to internal controls, right? So once we go through our discussion of internal controls, then we'll start talking about, okay, one, what are the safeguards? What are the internal controls that are most important when it comes to cash? And then we will start talking about, okay, if you are at an organization and they obviously will have cash accounts, what are some of the things that need to be done to those cash accounts that we haven't talked about yet, right? We've talked about making journal entries to cash. We've done 1 million of them by this point. But what else does the organization have to do with their cash in order to make sure that they're accounting for it properly? That's what we're going to talk about, again, sort of the second half of the chapter. Okay, everybody cool with sort of our roadmap, what we're doing today? Okay. So, internal controls. The purpose of a system of internal control is to essentially provide safeguards around a business's activities. Okay, so day in and day out at an organization, there are different types of transactions that are being processed, different types of activities that are going on, right? We're buying inventory, we're selling products to customers, employees are working and we're keeping track of how to pay them. We're using fixed assets and we're keeping track of depreciation, right? All of these things are going on within an organization every single day. And so what the internal control system needs to do is to make sure that all of those activities, all of those processes go off without a hitch, that they happen the way that they are intended to happen, that nothing goes wrong on a day-to-day basis with those types of activities, okay? And so the internal control system is built to make sure that nothing goes wrong on a day-to-day basis. The internal control system, by doing that, is protecting the company's assets, right? If we make sure that nothing goes wrong on a day-to-day basis, as we are receiving cash from customers, as we are paying cash to our vendors and suppliers, as we are receiving inventory into our warehouses when we buy it, right? If we have internal controls set up to make sure that that all goes the way that it's supposed to, then what we're doing is protecting our assets. Right? That's number one. Number two, we're ensuring that we have reliable accounting, right? Because part of protecting the process and providing safeguards to the process is making sure that at the end of the process, a journal entry gets made into the accounting system, right? So imagine the company and the process that they have to go through to sell products to customers, right? A customer places an order, the company has to get the items ready, they have to ship those items to the customer, they have to send the customer a bill. That's all the process of selling goods to a customer, right? But at the end of that process, what needs to happen? The accountants have to make a journal entry, right? Debit accounts receivable, credit revenue. Because if we don't do that, then there's no record of that transaction ever happening. If it doesn't make its way into our journal, there's no record of that sale, right? I missed part of the sale, right? Debit accounts receivable, credit, sales revenue, debit cost of goods sold, credit inventory, right? The other side of the entry. 2 entries made when we sell products to customers. So our system of internal control, which is made to safeguard these processes, is helping us to ensure that we have reliable accounting. We're protecting our assets, we have reliable accounting. It's also helping us set standards, making sure that people are following policy, right? And so oftentimes you walk into an organization in a new role, some of you may have internships that you take on during your time at Hiram. You walk into that internship role, they may hand you like a employee handbook, and it outlines what are the roles and responsibilities of the individuals that are in this organization, right? Who do you have to report up to, right? Those kinds of things. So a system of internal control, by providing these safeguards around our business process, We are also making sure that people are following policy, right? If you're supposed to report up to a certain individual, it's written in that handbook, we will implement these internal controls to make sure that you're doing that, to make sure that you're following those company policies. And then also, it's not about, oh, let's make sure that we safeguard and have guardrails around everything. And it creates total inefficiency, meaning the processes take too long. They cost too much money, right? That's not the point of internal controls. So internal controls should also be helping to promote efficient operations, right? Let's make sure that we're doing things as quickly as we can, but with the guardrails up, that it's happening the way that it's supposed to, that nothing's going wrong as we sell products to customers, buy supplies from our vendors, pay our employees, track our depreciation, right? All of these business processes, we want them to happen quickly and effectively, right? So internal controls should be promoting efficient operations as well. Okay, so let me ask you a question. If you think about your own work experience, okay, can you think of an example of an internal control that was going on in your work experience at your place of employment? Things like where something had to be authorized, or things like where a task that you were performing had to be supervised by someone, had to be overseen by someone. Was there any of that going on in your individual work experience that you can recall, Logan? No, anything.
When I was working at a welding shop, you had to lock out the machine before going in to service it, so.
Absolutely, that's an internal control. Safeguarding the asset of the machine, right? And of the employee, right? Even though we said employees can't be assets. I know we've said that a million times, right? But you're still safeguarding around something going wrong with that manufacturing process, with that welding process. Excellent example. Has anybody had to fill out a time card as in work study at Hiram College? Does someone have to sign off on that time card? Who has to sign off on that time card? Right? Probably different people for each of you, but a supervisor. That's an internal control. They're making sure that, Jared, you actually did work these hours. Someone of authority is going to sign off. Yes, I saw him. He was here, so on and so forth, right? That's an example of internal control. They're making sure that the process of payroll, right, of work study is happening the way that it was intended, that nothing's going to go wrong. There's a supervisor approval involved. Okay, so those a couple of specific examples. Does that make sense about sort of what internal control is supposed to do? Yes, no? Any questions so far? Why am I talking about this with you? The reason why I'm talking about this with you is because there was a rule that came out. It's called the Sarbanes-Oxley Act of 2002. This was a piece of legislation. I think that we may have talked about this in chapter 1, which was like 10 years ago. But it's a piece of legislation that was enacted by Congress in 2002 that said that not only do companies have to have an accounting system that produces financial statements, right? That's a rule. If you are a company and your stock is traded on the New York Stock Exchange, you have to make financial statements on a quarterly basis and on an annual basis. It's a rule by Congress, okay? And they came out with another rule in 2002 that said, not only do you have to produce those financial statements, but the organization also has to implement a system of internal control, okay? Now, why did this happen in 2002? Has anybody ever heard of Enron? Have you heard that company name before? Yeah, I know you have, Bryson. Cooper has too, right? In my FYEN. What do you know about, Riley? You weren't in my FYEN. What do you know about Enron?
Doing a lot with like,
Yes.
All that stuff.
Thousands of people, tens of thousands of people. This was a billion-dollar corporation, international organization that crumbled because they were abusing the accounting rules to create financial statements that made them look more profitable than they were. They wanted to beat their expectations. Like, what did people expect us to make in profit? We're going to beat it every year. But it was all fraudulent. It was all false. It wasn't actual money that they were bringing into their organization, right? And so what happened with Enron is that they had no internal controls. There was no process. There were no policies in place to say, wait a minute, you can't do that. Or wait a minute, that's not how that's supposed to go. Or wait a minute, this needs to be off. You can't just willy-nilly get yourself involved in different business transactions. There has to be a process involved. There was none of that, right? And I'm obviously simplifying it. It goes into a lot more detail that, we don't need to dive into. But the point is that when that insane accounting fraud came out, Congress said, oh, maybe these companies should have safeguards. Maybe these companies should have guardrails on their processes to make sure that when people start to veer out of line, boom, there's the guardrail, there's the rule, there's the internal control that brings them back to the middle lane, right? That brings them back to operate and function their organization in an appropriate way. So, giant scandal, new rule. That's typically how it goes in our society, right? Giant scandal, and then someone says we should probably make a law about that. That's what happened here, right? So again, why am I talking to you about internal control? Because if you pursue an accounting degree, which is my presumption, even though I know it's not the case for most of you, if you presume an accounting degree and go out into the accounting profession, you have to follow these rules. The Sarbanes-Oxley Act of 2020 or of 2002. Okay, and the rules say that the organization has to implement a system of internal control and that an auditor has to come in and check and make sure that it's working properly, right? Are those guardrails actually providing a safeguard to the business processes? Are those guardrails, those internal controls, actually making sure that nothing goes wrong in their business processes? The auditor has to come in and say, yes, that's happening, or no, it's not, right? I point to myself as the auditor, right? If y'all remember my introduction to this class, that's what I was. Prior to coming and teaching at Hiram, I was an auditor with Ernst & Young. And so part of my job was not just to look at their financial statements, right? Income statement, statement of retained earnings, balance sheet, cash flow statement. I had to look and make sure, are they following the accounting rules in those statements? That was job number one. Job number two, as of 2002, was now the auditor also has to say, do they have internal controls or not? Do they have a system of safeguards within their business processes? And if so, is it working properly? That was part of my job. Make sense? Okay. And this kind of stuff is easier for larger organizations that have a lot of resources, right? So I think I brought up to you one of the clients that I worked for was Smucker. So the jelly jam, whatever. And their internal controls were very robust because they had a lot of resources. They had a lot of technology implemented. They had resources to hire people to do certain tasks to make sure, again, that they had those safeguards. But then there were other clients, very small clients, that don't have as much revenue generation, that don't have as many resources. And it was tough. It was tough for those businesses to implement a system of internal control, right? So this is something that, again, is a rule enacted by Congress, right? A piece of legislation, but depending on the type of organization, it may be more difficult to try to follow these rules and to try to make sure that they have an operating system of internal control. So just, again, keeping in context sort of why we're talking about this. So what are some of the foundational principles of internal control? When you're thinking about, okay, I'm going to start my own business and I want to make sure that there are safeguards to how I operate and how I run the different processes within my business. What are some of the things, the foundational principles of a system of internal control? Number one, establish responsibilities. We should make sure that everybody knows what they are responsible for, right? Because the way that you're able to safeguard against things going wrong is to identify when those things go wrong and figure out who's responsible and make them fix it, right? Establishing responsibilities, one of the core principles of internal control. Number two, maintain adequate records. So as I said, right, for one type of process, selling goods to a customer, there's a bunch of different things that have to happen before we make that journal entry. We have to make sure we have the inventory. Well, we receive their order, right? We have to make sure we have the inventory available. We have to make sure that we ship it to them in a timely way. We have to make sure that we bill them, send them an invoice to show what they owe us. We have to receive the cash from them, right? All of that is the process of a sale transaction. We want to make sure that at every point in the process, we're maintaining what's called an audit trail. An audit trail is basically a stream of documents and records that show us from start to finish what happened with this transaction. So our system of internal control should be set up that we're saving documents, that we have backup files of electronic communication and documents and records, right? We should be creating an audit trail for all of our transactions, maintaining adequate accounting records. Number 3, our internal control system should ensure physical assets, right? We have inventory on hand. We have a lot of expensive machinery and equipment. We should have insurance for those things. If something goes wrong with those assets, that could be extremely harmful to our organization. So we want to have insurance on those types of physical assets that we own and can benefit from having. Number 4, separate record keeping from custody of assets. So the ones that have a little asterisk next to it mean that there's a additional slide for it. So again, a core principle of internal control is we should separate people who are responsible for physically handling assets like inventory, machinery and equipment, and cash. They should be separated from the people who are able to make journal entries in the accounting system. Think about it. What's the risk? I have access to our online banking system and to our accounting system. I could create a fictitious vendor that the company is going to pay money to and cover it up with a journal entry, right? I have access to the cash and I have access to the accounting records. I could steal the cash and make a journal entry to cover it up. I work in the warehouse, right? And I have access to the actual inventory that we sell to our customers. And I also have access to the accounting system. I could take some of that inventory, put it in the back of my car, and make a journal entry to cover it up. Okay. So again, yes, please.
Well, you were working as an auditor. Did that happen?
I did not. I did not have any experience, direct experience with fraud in that, of that nature. No, I did not. It's not because a lot of the organizations that I was auditing were larger companies that had a lot of resources to implement internal controls, right? So they had safeguards around those things. So it wasn't very often that I worked with a client that they even had the opportunity to do something like that. Does that make sense?
Yeah.
Yeah. Good question. What now? So again, one of the core principles of internal control is that we want to make sure our rules, our safeguards are set up such that the people who have access to the assets are separate from the people who have access to the accounting records. There should not be a situation where someone can steal an asset and make a journal entry to cover it up. Those two things should be separated. Does that make sense? So again, one of the core functions of a system of internal control. That was number 4. Number 5, divide up responsibilities to create checks and balances. So again, that kind of plays along with number 4, separating the custody of the assets with the actual record keeping, the accounting of those assets, is that we want to make sure that there is a system where things need to be authorized, where there's supervision involved, so that you create checks and balances within the organization so that not one person has the power, right, to commit that type of fraud within the organization. So setting up a system, dividing up responsibilities to create those checks and balances. Number 6, use technology in your system of internal control as best you can, right? So some of the ways that you may see technology be used in your everyday life, cash registers, right? If I think someone had said that they worked in retail before, was that the case? So did you have to operate a cash register, Sky? Right? And was there a way that you had to sort of sign into the register, sign out of the register, that kind of thing? Absolutely. So do you mind me asking where you worked? Okay. Oh, okay. I was gonna say, it seems like that would be, because that's pretty advanced in terms, you know what I mean? Like thumbprints or retina scans, those are advanced technology and kind of expensive sometimes, right? So, but if you invest in those kinds of things, that safeguards your assets, right? You can use technology as a support in your internal control system. So with cash registers, with other electronic data files, right? You have to have access to those things. You have to use security passwords, that kind of stuff, right? Time clocks. So Hiram College uses physical time cards still, right? Jared, would it be, I don't even want to ask, never mind. It could be easy to sign off as a supervisor on that time card, right? But with a time clock, where someone has to have an access code to log in and log out. And then there's a supervisor that watches over people clocking in and clocking out. That again, we can use technology to help us implement our system of internal controls. And then ID scanners, the same kind of thing as what Sky was talking about with thumbprints, right? I have my ID and they program it so that I can get access to the forum. If you try to swipe your ID, you should not be able to open up the doors to the forum, right? But I can, because they give me that access via this sort of scanner technology, okay? So again, the idea here is that one of the principles in our list of this sort of foundational principles of internal control is that we can use technology to help support our internal control system, right? The level of technology is going to depend on the resources of the company, right? The trampoline park had enough resources they can buy a scanning device that allows for sort of the signing in and out of registers, time clocks, and those kinds of things. Some organizations may not have the resources to invest in something like that. So the level of technology is going to be different depending on the type of company you're talking about. And then number 7, perform regular and independent reviews. So one of the ways that we are going to specifically talk about performing independent reviews is in the cash account at the end of this chapter with what's called a reconciliation, okay? So on a periodic basis, what a company should be doing and what we're going to practice doing in class today and on Friday is they should look at their bank statement. Y'all probably don't get a paper bank statement anymore, right? But they're available online if you have a bank account. You can log in and see what was everything that I took out of my bank account this month. What was everything that I put into my bank account this month, right? Companies have the same thing. They get a bank statement at the end of the month. What went in, what came out, right? Let's look at that bank statement that's maintained by that bank and let's compare it to our accounting records, right? Because remember, all along, our accounting records are also supposed to be keeping track of what cash came in, what cash went out. So this reconciliation process provides us with a regular review. Let's look at what our accounting records show, and let's look at what the bank records show. And if there are any differences between our accounting records and the bank records, let's figure out why those are different. What could have happened that would create differences between our accounting records and the bank statement, okay? And that's the independent review that we're going to do at the end of the chapter today, and again on Wednesday, okay? So independent regular reviews. Another way, let me just tell a brief story. Did I talk to you guys about the hot dog manufacturing company that I audited? Okay, so the company who produces Sugardale hot dogs and bacon and ham products and all that stuff, also one of my clients. And on a periodic basis, what they did was called a physical inventory count. They would stop production and they would have to count all of the inventory that they currently had in the facility, right? Stuff that was finished and being stored, stuff that was in process, right? They weren't done making the hot dog yet. Raw materials to produce hot dogs, right? All of that had to be counted. And then what they would do is say, okay, here's what we counted that we have on hand. Let's compare that to what we show in our accounting records for our inventory, right? An independent periodic review, reconciliation. Here's what we physically counted that we have on hand, and here's what we show in our accounting records. Are there any differences, right? And there could be, right? What if some of the product was spoiled and they had to throw it away? They may not have made an entry in the accounting records to adjust for that, right? So there are reasons, legitimate reasons why they might be different, but the point is you won't know they're different until you perform a periodic review and compare. Here's what we have on hand. Here's what we have in our accounting records. Let's figure out where there are differences, right? As an auditor, part of my job was to go in and observe those inventory counts. So at 3 o'clock in the morning at the hot dog manufacturing company, I was there in my full garb and steel-toed boots, walking around their manufacturing facility, making sure that they were doing this inventory count in the right way. I would do check counts, like, okay, you said that you had, 500 of this product. I'm going to test and make sure that I also count 500 of that product. Part of the auditor's job was to oversee those periodic reviews to make sure that the company was doing it correctly. Okay. So again, looking at our accounting records versus what we have on hand, we're going to do that for the cash account later in this chapter, but that is an example of a independent review reconciliation that we will perform on a periodic basis. Okay. Principles of internal control. Any questions on that? Then I'm going to jump over the ones that we went through already. Limitations of internal control. Okay. Some of the limitations of internal control is that we are working with human beings that can make mistakes, honest mistakes, right? We're not talking about fraudulent mistakes, because fraudulent mistakes are where you intend to do something wrong, right? This is unintentional errors that can happen within a business organization's processes. There's really not much that you can do about that, right? If people are confused about their job responsibilities, if people misunderstand what it is that they're supposed to be doing, what their tasks are. Now you can go back after the fact and try to sort of remedy that misunderstanding, remedy that confusion, right? But someone being confused, someone making an honest mistake could happen in the course of business processes. It's a limitation. There's nothing that we can do with our internal controls that can prevent a human being from making a mistake. There's nothing we can do about it. When it comes to fraud though, right, there are things that we can implement. We talked about some of them: separation of duties, dividing up responsibilities to have checks and balances. But there's nothing that we can do about collusion. Have you heard that term before? I think it may have been on one of the previous slides. I didn't specify it. Yeah.
Two people working together.
Exactly. Two people coming together to commit fraud. So Bryson is in charge of the cash account and Riley is the accountant. And Bryson says, hey, Riley, I'm going to steal this cash. You make the journal entry and cover it up. That's collusion, right? And so what if we say, okay, in our internal control system, we're going to hire Z and she's going to oversee the cash account and the accounting, right? And they just nudge her and say, hey, Z, you want in on this? And they cut her in on it, right? So you can add layers of, you would never do that, right? Never. Your eyes popped out of your head. But my point is that you can add layers of supervision and it still can't prevent collusion, right? We could say, okay, then Logan's going to oversee what Z's job is. They just cut Logan in, right? So it can go on forever. The idea is that you cannot prevent collusion in a system of internal control. You can set up safeguards to try to prevent fraud by an individual, but when it comes to collusion, it becomes a lot more difficult, okay? And so with fraud, we have to understand the difference between fraud where there is an intent to deceive and human error, unintentional mistakes being made, okay? Any questions about that? Limitations of internal control. Okay, so we're going to shift now, right? Remember I said the first part of the chapter is all about internal control. And then the second part of the chapter is focused on, again, we're sort of tunnel vision on cash in this particular chapter. So we're going to shift our focus and start talking a little bit about cash, right? We have used cash in almost every example that we've gone through in class, right? Debit cash, credit cash, debit cash when we're receiving it, credit cash when we're spending it. We've done that a million times. So what is cash? Currency, coins, deposits, and accounts, okay? But there's this other category of cash called cash equivalents. Cash equivalents basically means that it's not cash yet, but with the click of a button or with a phone call, we can immediately turn it into cash, right? So let's say that we had an investment out there, and in the next week, that investment was going to be cashed out. We would call that a cash equivalent. It is this close to being cash, right? It's this close to being cash in our pocket, just not yet, right? But we could easily and readily convert it into cash if we needed to, a cash equivalent. So cash is what we normally think of. We have deposits at a bank, we have cash in our pockets, right? But a cash equivalent, not something that you normally would have thought about outside of this class. When you look at a company's financial statements, oftentimes their first asset, right? We said the number one A1 asset on the balance sheet is always cash. More often than not, the company will say cash and cash equivalents. That's how they'll label that first asset, because they want to consider not just the cash that they have deposits in bank and currency on hand, but also any readily available cash that, again, with a click of a button or with a phone call, could immediately be cash in our accounts, cash equivalents. Okay. So if we think about internal controls and we think about how might we be able to apply those principles of internal controls around the cash account, right? We've talked about a few of the main types of internal controls that we would want to build around cash already. We said that we want to have separation of duties, right? The individual who is responsible for accessing the online banking system, making payments, receiving cash from customers, should not also have access to the accounting system. We want to separate those two things, right? And so the main internal control principle as it relates to cash is going to be that separation of duties. Making sure also, right, that we understand who is responsible for each of those tasks. It is clearly laid out in our policies. This particular person or role is responsible for maintaining the online banking system. This particular person or role is responsible for updating the accounting records. We have to make sure that we designate those responsibilities very clearly to the individuals working within our organization. Okay. Other things that we might want to think about when it comes to internal controls around cash, beyond just separating responsibility, right? We also said that we want to maintain an audit trail, okay? One way that we can do that with our cash account is by always making sure that we make payments either through EFT, which is designate abbreviation for electronic fund transfer, or check, right? We want a physical record that cash was paid, essentially. We don't want to be able to pay vendors with currency cash that we have on hand. We need a physical record that the payment was made. So making sure that all of those payments are made by electronic fund transfer or check so that we have an audit trail. We have documentation that we did make those payments. And then if we receive cash, so again, imagine you're working in an organization. They receive cash from their customers in a mailroom, right? The customer sends a check that goes into their mailroom. We want to make sure that there is as short a period of time as possible from when we receive that check to when it gets deposited into the bank, right? Because the longer that we have that check just kind of floating around our organization, the more likely something could happen to it. So as cash receipts come in, if they are physical checks, we want to make sure that we get them deposited into the bank as quickly as possible, okay? So again, just thinking about how we can apply those internal control principles to our cash accounts is sort of the purpose of the beginning part of this slide. Then the second thing that I want to talk about with cash, before we get into sort of the accounting for cash, is about cash management. Okay, so two general principles of cash management are that we want to plan our cash receipts for when we have to make cash payments, and we want to keep a minimum level of cash on hand. So as little amount as we possibly could need, keep that on hand. Okay, so for the first one, if we are planning our cash receipts, meaning when we're getting our cash from customers, if we're planning that to coordinate when we have to make cash payments to our vendors and suppliers, well, then that creates a nice, seamless, efficient flow of cash in from our customers, cash out to our vendors, right? It creates more efficiencies for our organizations if we're able to sort of time those things up. It's not always the case that we're able to, but we can try, right? We can think about how to make sure that sort of calendar-wise, are we timing those things up? And then the second goal, keep a minimum amount of cash on hand. Because what do we want to do with any excess cash that we have? Yeah.
Invest it, make it grow.
Exactly. Invest it. Let's make money without doing anything, right? Isn't that our dream? Let's make money without doing anything. So we keep a minimum amount of cash on hand, meaning in like our checking account that we can use to pay off bills, that we can use for payroll purposes, and anything above that minimum amount that we need, let's put it into an investment account. Let's earn a return and make more money on the cash that we have, right? I don't want it just sitting around. I want it to work for me. So let's invest it, okay? So 2 general goals of how we manage our cash. Let's make as seamless and efficient of a flow, cash in to cash out as we can. Try to time those things up, right? We know we're going to have a bunch of bills that we have to pay at the end of the month. Let's try to coordinate when we receive cash from our customers, right? We'll offer them a discount. Remember, we did that in chapter 4. Let's offer them a discount. That will entice them to pay us when we want them to pay us. Time those things up. And then 2, keep a minimum amount of cash on hand. That way, any excess cash that we have, we can make work for us by investing it, okay? So 2 general areas of accounting for cash that we're going to discuss. So we've talked about internal controls. We've talked about how we can apply those internal control principles to our cash account. Now let's dig into accounting for cash. Again, it's been very simple so far, and I think it'll still be simple as we work our way through these 2 quick examples, right? But cash in, debit cash, it's our asset. Cash out has been credit cash, right? And what we want to make sure that we also understand is what happens if we are operating a cash register within our organization and the cash that we have in the drawer doesn't match up to the cash that's in the register tape, right? As you make a sale to a customer, as you process a return, right? Maybe the customer brought back merchandise and you had to give them their money back. As all of that's being processed in the cash register is keeping a record of it. It's keeping a log of it, right? And so at the end of a shift, perhaps at the end of a day, what a company should do is say, okay, what does it say in our register that we should have in cash? And then let's actually count how much cash that we have, right? Has anybody ever had to do that? Had to reconcile their drawer? Okay, I did too. I worked at a grocery store when I was in high school, right? At the end of my shift, I would have a printout in those days because it wasn't electronic. And it would say, here's how much cash you should have in your register based on all of these transactions. And then I would have to count down my register. And if it didn't match up, I would have to figure out why, right? What happened? Why didn't it match up? Okay. If it doesn't match up, the accountants have to make record of that. Okay. So here is an example. If the cash register record shows $550 of cash should be in the register, but we actually have $555 of cash in the register. We actually have $5 more than what we should have according to that cash register log, right? What do we do about it? If we can't figure out where that $5 difference comes from, right? The accountants still have to make an entry for it. So you see the highlighted in red name, cash over and short. It's the generic account that we use whenever we have to make an adjustment to where our register log doesn't match up to the actual cash we had in the drawer. Okay, cash over and short. So I'm just, sorry about that. I'm just presenting this to you as an example. Again, this is an internal control. At the end of the shift, what did they do? They took the register, they took the cash that was on hand, and they compared it and figured out that there was a $5 difference. This is an example of internal control. And in this example, we would have to make an entry for it. Cash over and short is the generic account. I'm not going to ask you to make this kind of entry on a quiz or an exam, just presenting it to you so that you see that it's not just, oh, let's figure out why it's different. It's like, no, we have to actually adjust for it in our accounting records too. Okay, cash over in short. Any questions on this? Okay. So then the final thing that we are going to discuss is how to do a bank reconciliation. So I mentioned earlier, right? One of the principles of internal control is that we do periodic reviews of our accounting records, right? Periodic independent reviews. One example of that is a bank reconciliation. And in a bank reconciliation, what we are going to do is we are going to look at our bank statement and we are going to compare it to our accounting records. Okay. So in the example that we go through, so we're going to go through an example in class, and then we're going to pick up with an additional example on Friday. In the example we go through, okay, anytime that I am referring to the bank statement, I'm just going to say the bank. Anytime I'm referring to the accounting records, we're going to call that the books. So essentially, this reconciliation is going to be a comparison of the bank and the books. The bank is the bank statement. We get that from that third-party financial institution. They send it to us at the end of the month. And our books are our accounting records. It's where we've been making debits and credits all month long. Okay. And so in this bank reconciliation, right, we have to identify where there might be differences between the bank and the books. My question to you is, before we actually dive into going through an example of this and learning how to do it, why might there be differences between the bank and the books? The bank statement and their record of our cash and our accounting records, our books. Why might there be differences? What if we write a check to a vendor? We pay a vendor. How would that affect our cash in our books? It would decrease it, right? What if the vendor doesn't cash our check? The bank has no idea that we wrote that check, right? The bank only has record of us writing that check when someone comes in and cashes it, right? So on our accounting records, we would show a decrease to cash, right, Isaac? Our cash would go down. And the bank would have no idea that that happened. We know it happened because we wrote the check. The bank will only know when the vendor or the supplier comes in and cashes it. So there is a difference between our books and our bank. Now, does that mean that someone made a mistake or it's fraud? No, it's just a timing difference, right? We know we wrote the check. The bank doesn't know yet because they didn't bring it into cash. That's it. Very simple explanation. So when we do these reconciliations, it's not that we're intending to find fraud. It's just we want to understand why there might be differences. Okay. I'll give you another example. What if some of our customers pay us by direct deposit into the bank account, electronic fund transfer, right? We may not know until the end of the month that that payment came in, right? We wait until the end of the month to see that bank statement. And then we see, oh, that payment came in to the bank. It's not on our accounting records because we didn't know it went in yet, right? Just timing difference. What if our bank account earns interest, right? So we have this outstanding account with the financial institution. At the end of every month, we earn interest on our outstanding balance. We won't know what that interest is until we get our bank statement, right? So the bank knows we earned interest, but our accounting records, our books, we didn't know yet, right? Timing differences, okay? Now, can this process uncover fraud and mistakes? Sure it can. In the bubble of this classroom, we're going to assume just honest timing differences. We're not hunting for fraud. I just want you to understand the process that we go through to perform this bank reconciliation. And again, the purpose of it. the purpose of it in terms of internal control, this independent periodic review, so that we make sure that our cash account is as up to date as it can be. It's as accurate as possible. So we perform this month-end reconciliation. The source documents that we are going to use in this bank reconciliation, as I mentioned, is the bank statement and the accounting records. In each of the examples that we go through, I'm going to give them to you. So I'm going to give you the bank statement and I'm going to give you the accounting records. And in this first example, we're going to walk through together how to do the bank reconciliation. And in the example that we start on Friday, you're going to do it on your own and you're going to get a grade on it. Okay. So instead of having a separate quiz for chapter 6, what you're going to do is a bank reconciliation in class on Friday with me here to ask questions, right? But I am going to grade it. Okay. You could work with each other, just like we've done with other examples that we've done in class, but you're going to submit your own bank reconciliation for me to grade for chapter 6. So you don't have a quiz for chapter 6. You'll have a quiz later on that covers a little bit of chapter 6, but it also will encompass chapter 7. So we'll talk about that next week. Okay. So how do we go through this process? First of all, you want to open up the Excel workbook that's in Moodle. So if you are in Moodle, cash and internal control, here's the bank rec. That's what it's labeled. And when you open that up, this is what it looks like. Now, I am obviously simplifying the way a bank statement appears and the way an accounting record, accounting ledger of cash would appear. So for our purposes in learning this process, I'm simplifying. An organization may have hundreds of transactions on their bank records for a month. Hundreds, right? Thousands maybe even, depending on how big the organization is. We're going to simplify it here. But in this Excel spreadsheet, what you see on the left-hand side, this is our bank statement, okay? So we are, who are we? Well, I don't think it matters. Oh, account holder. We are Acct225, section 1. That's our company name. And this is the bank statement that we just received for the month of September. And then on the right-hand side is our ledger. Here is every entry that we made to cash throughout the month of September. Here's all of the debits that we made to cash. Here are all of the credits that we made to cash, right? So debits mean cash in, credits mean cash out. And what we have to do is figure out why are the balances not the same, right? So the first thing that we would do in this bank reconciliation problem, or bank reconciliation process, I should say, is look at our ending balance on our bank statement. It's $19,622. That's what the bank says we have in cash. And look at our accounting records ending balance. We say we have $20,602. Because they are different, we need to move forward with a bank reconciliation. If they were the same, we would say, okay, there's no reason to do a reconciliation. They're the same. We have the same amount of cash in our bank records as we do on our accounting records. Done. So the reason why we are doing this is because the bank balance of $19,622 is different than the book balance of $20,602. Does that make sense? That's the reason why we're doing this. Okay. So what do we have to do with our bank statement and our books? Step 1, inspect the bank statement and the books and identify items that are not shown on both. So what I am saying is we have to inspect our bank statement. And for each one of these transactions, we have to see, is that same transaction reflected somewhere in our books, in our accounting record? If it's not, flag it. We have to talk about it, okay? So what you are going to do is you're going to go through, and we're doing this right now. We're doing this right now, okay? So we are going to go through and start this bank reconciliation process. Step 1 is to identify items that appear on one and not on the other. So you are looking at your bank statement and saying, here are the transactions that the bank has. Do I see all of those same transactions over here on my accounting records? And if there's one that you see that's on the bank and not on the books, flag it, highlight it, make a little mark of it, okay? And then what you're going to do is you're going to look at your accounting records and you're going to say, here are all of my accounting records of cash. Is there anything on my accounting records that does not appear on my bank statement? It's on my accounting records and it's not on my bank statement. And again, flag it, highlight it, okay? So I want you to spend the next 10 minutes or so identifying these items. It will appear on one and not on the other. That's what you're looking for. Where are there items that appear on one and not on the other? Group together, bounce ideas off of each other. And then, like I said, 10 minutes, and we'll come back and we'll talk about what items did you identify that appear on one and not on the other. Okay, if you have questions, raise your hand. I'll give you a hint. You should identify 5 items. Joe was like, I thought it was done. You should identify 5. Anybody find all 5? You good. Is that from Toy Story, your t-shirt? Did everybody find all 5? Anybody need a couple extra minutes? Okay, even better. So someone raise their hand and tell me what's one of the reconciling items. That's what we're gonna call these things. So an item that appears on one and not on the other is called a reconciling item. Joe? Yep. And so I'm gonna highlight that because that appears on the bank statement and does not appear on the accounting records, right? What does that transaction represent? What happened there? Here. Which means it got declined. We thought we had money from a customer, 631 bucks, thought we had it. And the bank now is telling us, no, you don't. The bank, oops, not a 3, a 6. The bank is decreasing our account by $631. They're saying, no, you don't have that money, right? The point of this process is that we want our bank and our books to be equal. Right now, they're not. Right now, the bank statement balance is $19,622, and the accounting record balance is $20,602. We want them to be the same. So if on our bank, they have a decrease of cash, $631, what do we need to do to our books to make them the same? Decrease 631. So when we get to the following tab, which I don't think we're going to get to today, but when we get to the next tab and we actually prepare our bank reconciliation, what we have to remember is that our books need to decrease by 631. Are you with me? In order for them to be the same, our books need to decrease by 631. So I'm going to put a little asterisk. That means it needs to go into our reconciliation. And like I said, we'll probably get to that on Friday. Okay, that's one down, 4 to go. Michaela. Absolutely. So this is the scenario that I described to you, right? The bank, we earn interest on our account, but we don't know what it is until the end of the month, and they accrue our interest and show it to us in our bank statement. So the bank shows $23 extra that we don't have on our accounting records. So what do we need to do to make them equal? Add $23 to our books. And again, these are going to be the items that we include in our reconciliation that we will do on Friday. Okay, 2 down, 3 to go. Sky. Yes. Check 5906. So this is a check. It is a credit to cash on our accounting records of $1,003. Yes? Nowhere to be found on the bank statement. And we want them to be equal. So on our reconciliation, what do we need to do to make them equal? Minus 1,003. That is going to be a reconciling item on our reconciliation template. Make sense? 3 down. You can go, Jacob. Check 5908, $378. And again, what is the scenario that plays? Like, what had to have happened for this to be the case? That we have a check, we wrote it, and the bank doesn't know about it. Got it. They just didn't cash it yet, right? Whoever we gave the check to make our payment, they just haven't cashed it yet. So we have, what is it? Oh, I didn't highlight it, sorry. We have $378 that we know is not in our cash account. The bank doesn't have any idea. We want them to be the same. What do we do? Minus 378. That's going to go in our accounting, or I'm sorry, that's going to go in our reconciliation template. 4 down, 1 to go. Donovan. So what had to have happened here? That we had a debit of 1753 on our accounting records and nothing appeared on the bank statement. Maybe we got that check. Oh, go ahead. And we didn't deposit it yet, right? So we know we have it, but maybe it was Friday at 4 o'clock. And so we didn't get a chance to take it over to the bank, right? Again, these things aren't fraudulent. There's no like big scandal happening, just timing differences from what we know about our cash and what the bank knows about our cash. So in this case, we had 1,753. We know we have it. We just haven't taken the check over to the bank yet, but we need them to be the same. What do? Right? Then we need to make this plus 1,753. So that's going to go on our reconciliation template. Okay. So I like to take things in steps, if you haven't noticed. Step-by-step process. That's how I operate my life. Step one was identify those items. That's the most important step. The rest of it is, now that I know what my reconciling items are, let me just put it in a nice, pretty template. And in that nice, pretty template, what we want to show, I just gave myself a Charlie horse on my foot. Oh my God. What we want to know in that nice, pretty template, ultimately what we want to come up with is that the bank balance and the book balance are equal. We want them to be the same, right? If we look at our Excel template, they are not the same yet. So we want to use this bank reconciliation. So if you click on the second tab, we want to use this bank reconciliation to show, well, yeah, they might not be the same, but we know why. And the organization will do this at the end of every month so that they're always keeping track of, okay, yeah, we see that they're different, but why are they different? It won't go away. My dad used to take a spoonful of mustard. Anybody ever do that? Yeah, spoonful of mustard. I can't bring myself to do it. Pickle juice? I've never tried that. Anybody got any on them right now? Okay. All right. So when we meet together on Friday, we will pick up right here. Okay. And we have already identified our reconciling items. I'm actually going to take a picture of this so I draw it exactly like that in class on Friday. We've already identified our reconciling items, and I'm going to show you how to fill out the bank reconciliation. Okay. And you'll notice on this tab, not only do you have a template to actually do your bank reconciliation, but there's a journal. Why is there a journal? Because we just identified 2 items that need to be adjusted for on our books. That means we have to make entries for those. So any adjustment that has the asterisk that's under the book column, you actually have to make an entry. You want to make an entry that customer still owes us $631 because their check bounced. And we want to make an entry that we earned $23 of interest this month. We have to make entries for the reconciling items that fall under the book column. Does that make sense? So we will pick up with this example on Friday, and then I will give the majority of class time. I do want to spend maybe the last 15 or 20 minutes of class on Friday introducing you to chapter 7. But the majority of class time I am giving to you to do another bank reconciliation. Okay, we're not going to do it together. I'm not going to go through the solution like I'm doing with this one, but you can work together and bounce ideas off each other and ask me clarifying questions. But this is a graded assignment that you'll start on Friday. If you don't finish it in class on Friday, that's fine. I'll give you until the end of the weekend to finish it up. Okay, everybody cool? All right, I appreciate you. I'll see you on Friday.